Global financial markets in 2026 are experiencing unusual and persistent volatility across almost every asset class: stocks, gold, bonds, and cryptocurrencies. This is not caused by a single event, but by a convergence of economic, political, technological, and psychological factors. The world is transitioning through a rare period where old financial systems are being stressed while new ones are still unstable. Below are the key reasons behind this volatility. 1. The post-inflation and interest rate hangover. From 2021 to 2024, central banks aggressively raised interest rates to fight inflation. By 2026, inflation has slowed but has not fully stabilized. Interest rates remain structurally higher than the pre-COVID era. Markets are unsure when and how fast rate cuts will occur. Why this causes volatility? Stocks struggle because higher rates reduce future earnings value. Gold fluctuates as investors debate whether inflation is truly dead. Crypto reacts sharply to every signal about liquidity returning or tightening. Markets hate uncertainty more than bad news, and monetary policy uncertainty is at the core of 2026 volatility. 2. Global economic fragmentation, deglobalization. The world economy is no longer moving as one system. Supply chains are shifting from China to multiple regions. Trade blocs are forming based on political alignment. Sanctions and tariffs are now long-term tools, not temporary measures. Impact on markets. Companies face higher costs and unpredictable earnings. 3. Geopolitical tensions and permanent risk premium. By 2026, markets have accepted that geopolitical risk is no longer temporary. Major concerns include ongoing conflicts and proxy wars, energy and shipping route disruptions, defense spending replacing productive investment, market effects. Stocks sell off suddenly on geopolitical headlines. 4. Artificial intelligence shock to labor and valuations. AI is no longer hype in 2026. It is actively reshaping economies. Some companies experience explosive productivity gains. Others face job displacement, regulation risks, or obsolescence. Entire industries are being repriced in real time, resulting volatility. Tech stocks swing wildly based on earnings and AI adoption. 5. Stock market volatility, earnings versus reality. Stock markets in 2026 are volatile because corporate earnings growth is uneven. Consumers are financially stressed. Governments are running large deficits. Key issues: high debt refinancing at higher rates, weak global demand growth. 6. Gold volatility, safe haven versus strong dollar. Gold traditionally performs well during uncertainty, but in 2026, it is volatile because central banks are still buying gold. Real interest rates fluctuate. The US dollar remains structurally strong. Push and pull effect. Fear drives gold up. Strong yields pull money away. Short-term traders amplify price swings. 7. Crypto volatility, between adoption and speculation. Cryptocurrency in 2026 sits in a transition phase. Positive forces: institutional adoption, ETFs and regulated products, blockchain use cases expanding. Negative forces: regulatory uncertainty, market manipulation, retail speculation driven by social media. Why crypto swings so violently? Low liquidity compared to traditional markets. Leverage amplifies moves. Narratives change faster than fundamentals. Crypto reacts instantly to interest rate expectations, tech regulation, global risk sentiment. This makes it the most volatile major asset class. 8. Liquidity cycles and algorithmic trading. Modern markets are dominated by algorithms, high-frequency trading, passive funds. Consequences: price moves are faster and sharper. Stop-loss cascades exaggerate trends. Human emotion gets amplified by machines. Liquidity now disappears suddenly, causing flash crashes and sudden rallies. 9. Investor psychology, fear, fatigue, and FOMO. By 2026, investors are mentally exhausted. Multiple crises in one decade. Trust in institutions has weakened. Social media spreads panic instantly. This creates overreaction to news, shorter holding periods, herd behavior across all assets. Markets are not just reacting to data, they are reacting to collective anxiety. 10. Structural shift, not a temporary phase. Most importantly, 2026 volatility is not a short-term anomaly. The world is transitioning through a new interest rate regime, a new geopolitical order, a new technological era. Whenever systems change, markets become unstable until a new equilibrium forms. Global markets are volatile in 2026 because monetary policy remains uncertain. Geopolitical risks are permanent. AI is disrupting economic structures. Liquidity is fragile. Investor psychology is unstable. Traditional valuation models no longer fully work. Stocks, gold, and crypto are all responding to the same underlying problem. The future is being rewritten faster than markets can price it in. Volatility is not a sign of collapse. It is a sign of transition.